This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Since our crystal ball is totally unreliable, we look at an uncertain future as a series of probable outcomes. All we can do is interpret available data to make an educated guess for what may occur in the economic future. It's an imperfect science. If we had it all figured out, I wouldn't be working. I'd be on my yacht, definitely not recording Money Talks. Fortunately, for the sake of my ego, we're in good company. We have yet to encounter anyone else that's been able to consistently forecast the economic future. The solution to the inherent uncertainty is to diversify. Try not to get caught up emotionally in the daily market swings and realize that over a long enough time horizon, the value of quality assets, whether stocks or bonds or real estate, will appreciate. That's not to say you can't make some intelligent adjustments to investment portfolios to reduce risk, or take advantage of better performing sectors to increase gains. Clearly, this year has been hard on both stock and bond portfolios. We thought we'd share our thought process of where we think we go from here. In some ways, the uncertainty around the economic outlook this year has been even more difficult than the uncertainty around the COVID pandemic in 2020. Once it became apparent that infection rates would not continue to climb indefinitely, that economic shutdowns would be temporary, and that an unprecedented quantity of capital would be thrown at both consumers and companies, the strong likelihood of a rapid economic recovery became apparent. Although there were new winners and losers due to the extreme economic dislocation, work-from-home stocks soared, energy stocks crumbled, the market recovered rapidly. The economy recovered almost too quickly. In hindsight, it should have been apparent that flooding the economy with an unprecedented $3 trillion in stimulus, combined with also unprecedented supply chain disruptions, would have a longer-term impact on the balance of supply and demand for goods and services. 8% inflation is a problem. Rising prices, particularly for necessary goods such as food, shelter, and fuel, reduces real income, especially for those near poverty. The fiscal health of Americans has been improving substantially, partly due to low inflation. High inflation will quickly roll back those gains. The U.S. Federal Reserve has a dual mandate: maintain price stability, which means keep inflation in check, and to maximize employment. When these two, sometimes countervailing goals come into conflict, the Fed will sacrifice jobs in the near term to maintain long-term price stability. In other words, push the economy into a recession if necessary to rein in prices. The most effective tool the Federal Reserve has is inexact and toxic to the economy: raise interest rates. Raise them enough and you slow the economy. You reduce demand and correct the imbalance with supply. Economic chemotherapy. It'll make you really sick, but hopefully it kills the cancer. The hope was that a healthy consumer, a strong economy, could withstand an increase in rising rates, and the economy would still grow, albeit at a slower rate. The rise in inflation has been more intractable than anticipated, and the Fed has made clear its resolve that interest rates will need to continue to rise at the expense of the economy, even pushing us into a recession. Earnings drive stock prices. A stock isn't just worth what the next investor is willing to pay for it. Well, it is, except for the price will be grounded by the future cash flows, which is generally equivalent to earnings. Say if I were to buy a business, what should I pay? If I can be sure I can earn $100,000 a year from that business, I should be willing to pay $1 million. That's 10 times earnings, or a 10% annual return, which is great. If there's a lot of risk in the business, risk to those future earnings, I should pay less, since I can't count on that return. If the business is growing and my earnings could be a lot more in the future, then I should be willing to pay more. In a recession, earnings growth will decline, and lower future earnings will equal lower stock prices. So keeping this in mind, let's look at a few scenarios for corporate earnings on the S&P 500. This is a chart of forecasted earnings for the companies in the S&P 500 looking 1 year into the future. Forecasted earnings declined with uncertainty of the pandemic in 2020, and then reaccelerated and are forecasted to grow at a steady pace through 2023. Except that the likelihood of a recession, or at least considerably lower growth, has increased due to the rising interest rates. Maybe earnings expectations need to be revised down 10% from the current forecast. Or maybe we have a more significant recession. The average earnings decline in a recession is more like 30%. The recession of 2008 was even greater. Lastly, we have to consider the possibility that earnings do remain strong and even surprise to the upside. Maybe supply chain issues are resolved, inflation pressures dissipate, and the current estimates end up being low. It might be unlikely, but what if earnings are 10% higher than forecast? So far, the economy has held up better than feared. There isn't reason to expect a worst-case economic scenario, or even an average recession scenario. But it is true that the inflation and interest rate outlook has not been as good as hoped. The Fed's battle with inflation will not be resolved quickly. It's too early to anticipate a strong economic rebound in 2023. The most likely scenario is probably a middle case of a necessary 10% reduction to future earnings. When corporate earnings for the second quarter came in better than feared, stocks rallied sharply, moving 10% up from their mid-July lows. Since then, we've given back those gains with the prospect that rates will have to continue to rise, increasing the likelihood of a more negative earnings scenario. So far, earnings estimates have only been revised 4% down for 2023 from the peak estimate back in June. To assume earnings will not decline is too optimistic. We expect earnings will have to come down to, say, roughly a $215 level. That would be down 10%. Although earnings haven't been revised down, the market has been discounting a reduction. After all, the S&P 500 has declined more than 20% this year. Price to earnings multiples on one-year forward earnings estimates were at nearly 20 times back in January and even March. In this table, we show the 4 scenarios and what would be a reasonable earnings multiple and price performance of the S&P 500 based on that outlook. In simpler terms, where should the S&P 500 trade based on each scenario? We think earnings estimates are too high. We also think the market is discounting a coming 10% reduction in those earnings. This is still the most likely scenario, a recession, but not a deep one. Interest rates will move up. Housing prices have to decline. Unemployment will have to increase. The Federal Reserve forecasts 4.4% unemployment in 2023, up from 3.7% today. The Federal Reserve also forecasts the Fed funds rate to hit 4.6% in 2023, up from 3.25% today. We still have a ways to go. A deep recession is always possible, but unemployment's low. The consumer's in good shape. That's part of the problem. Prices move up because demand's too strong. The best case and the worst case are unlikely scenarios given the current data, in our opinion. For the forward-looking stock market, much of the damage is already priced in. If the economic results can continue to be better than feared, we will end the year higher than where we are today. As earnings forecasts have reason to start increasing again, well, that's when we'll start to see a sustained rally in the market. For that, we may have to wait a while. I'll leave you with one last thought. With the rise in interest rates, stocks and real estate are no longer the only place to invest. Bonds are increasingly attractive. Investment-grade corporate bonds are paying 5 to 7% for maturities of less than 10 years. It's been some time since bonds were an attractive alternative to stocks. There is risk in bond funds as interest rates continue to move higher, but for individual bonds held to maturity, they are beginning to look attractive for the first time in a long time. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.